In this session, we're going to continue our discussion about investing, and we're going to be talking about investing in bonds and investing specifically in mutual funds. Chapter 16 talks about investing in bonds. And just to give you a little background on bonds, bonds are any long-term debt securities that are issued by government agencies or corporations. A term for bonds is something called par value. For a bond, it's its face value or the amount returned to the investor at the maturity date when the bond is due. And most bonds, when they're issued, have maturities between 10 and 30 years. Issuers are required to make interest payments and to repay the par value of the bond itself. There are certain terms, certain characteristics of bonds. You'll sometimes read or hear about something called a call feature. And this is a feature on a bond that allows the issuer to repurchase the bond from the investor before maturity. And any bonds, because there's a certain risk factor associated with the fact that you may not be able to hold that bond until maturity, they usually offer a slightly higher return to the holder of the bond itself. There's also something called a convertibility feature, which is something that the bond is converted into a stated number of shares of the issuer's stock if the stock price reaches a specified price. These have a tendency to have a little lower return to them because they are, in essence, participating in the upward value of the company itself. A bond's yield to maturity refers to the annualized return on a bond if it is held to maturity. If a bond sells at par value, its yield to maturity equals the coupon rate. For example, if a bond is selling at the par value of $100 and you buy it for $100, all it means is whatever the coupon rate, if it's going to pay you 5% a year or whatever the amount is, that's the yield itself. If a bond that has a par value of $100 sells below that, let's say it sells at $90, that means that at the maturity, not only are you going to get the 5% coupon rate, but you'll also get that additional $10 of yield at the time it matures. And again, it goes the same way if it sells above par value itself. Bond trading occurs in a secondary market where investors sell their bonds to other investors before they reach maturity. And bond prices basically go up and down in response to interest rates out there. Brokerage firms may also be involved in bond trading. Let's talk about just some of the kinds of bonds that you find out there. One of them is Treasury bonds. And again, these are U.S. Treasury issued securities. The payments are guaranteed by the federal government. Interest is subject to federal income tax, but it is exempt from state and local taxes. And Treasury bonds can easily be sold in the secondary market. There are also municipal bonds, which are long-term securities issued by state or local governments. And these are usually considered to be low-risk type of bonds. And when you receive the interest on that, it's actually exempt from federal income tax, which is nice. Often the yields, the interest rates are lower because it's at a lower risk and taking into account that it's not subject to federal income tax. Federal agency bonds are long-term debt issued by various and sundry federal agencies, usually a low default risk on that, and interest is usually taxable on that. Another kind of bond, of course, out there is the corporate bond, which are just long-term debt securities issued by large firms. And of course, these, because there is no guarantee for a company, these are subject to default risks. There's something out there called junk bonds, which are very high yield bonds. And usually these are issued by smaller or less stable companies that are subject to a higher degree of default risk. So they're able to, the only way that they can sell those bonds is in essence for them to actually have a higher interest rate on that. When you look at corporate bonds, usually a corporate bond, when you're going out to check on those things, there's going to be the coupon rate, which is the actual percentage that is paid back. There's going to be the maturity. There's going to be the current yield, which is, again, takes into account the coupon rate and the amount that you're either paying above or below the face or par value. There's just the volume, so the ease that you have of being able to liquidate your holdings, the closing price, and then also you'll just be able to see what the net change in price is from the previous day activity. One of the things to understand is that when you are investing in bonds, that interest rates in total will actually influence the bond and the bond prices itself. And if interest rates rise, the value of your bond decreases, and if they fall, the value of your bond increases. And when you're talking about investing in bonds, there always are tax implications of any sort of investment to take into account. Interest is taxed as ordinary income when you receive a bond interest, unless it's a tax-exempt bond like a municipal bond. If you're selling bonds at a price higher than you paid, that's also going to result in a capital gain, and it'll be short-term capital gain. If you held that bond for less than 12 months and in excess of 12 months, it'll be a long-term capital gain. When you're valuing a bond, and this is kind of important to understand, is bonds use the time value of money. So you're always going to be looking at the present value of whatever the future coupon payments are. So if you bought a bond and you're going to be getting $10 on that bond a year for the next 30 years, in essence, that's an annuity stream of $10 times for 30 periods, and you can present value that back at a particular interest rate to then determine the value of what the bond is going to be. And that's where interest rates then have an impact on the bond value itself. Also, you'll be looking at whatever the par value or the face value, the redemption value of the bond itself, and you'll present value that back to today. So, of course, for the economic impact is the higher rate of return is only realized if firms are healthy enough to make payments. And as you get into unfavorable economic conditions, of course, it starts to put some of that at risk. So let's look at just some of the risk of investing in bonds, because just like any investment, there is a risk factor. Obviously, there's a default risk factor that the borrower, the person who issued the bond to you, will not be able to repay it. And quite often there's a risk premium that starts to get associated with a bond price that in essence you are willing to pay less for that bond because of the higher risk of default. But if you buy it at a risk premium, which means you buy it for less, and if the company stays in business and actually redeems it in total, you've actually made more return on that. So risk ratings will come into play with respect to just the pricing in the open market itself. Impact of any sort of financial crisis is going to also have an impact on default risks. In the financial crisis that we experienced recently with the mortgage crisis, there were many firms that experienced financial problems and basically were unable to make their bond payments. So all of these things really kind of have an impact on the potential returns of bonds themselves. There's also a risk out there for a call or prepayment. And this is basically, if there's a call feature in the bond itself, the issuer of the bond, let's say a company, can call that bond in, which means that you may or may not receive the full yield that you were anticipating on that. Also, of course, there's the interest rate risk that we talked about before, because when interest rates move, bonds are very sensitive, especially the longer term that they have. They're very sensitive to those interest rate movements. What are some strategies that you might employ in bonds themselves? Well, you're going to purchase long-term bonds if you expect interest rates to rise. and that's kind of a little more of an aggressive strategy. There's also a passive strategy where you go out and you invest in a portfolio that has many different kinds of bonds that are held for a longer period of time. There's also what's called a maturity matching strategy that you're going to be looking at your cash flows, and you're going to determine that at some point in time in the future, you're going to need to have this investment cashed out in essence. And so you want to invest until the time that it is going to be cashed out. And this is a very common strategy that people are looking for, where for college education, for example, or other kinds of significant events that can be tied and calendarized, such as expected retirement dates and some of those kinds of things. So as obviously the choice with respect to being involved with bonds has an impact on your financial plan. If you are going to invest in bonds, it's going to be what kind of bonds, how much should I do? Let's also talk in Chapter 17, another just perspective of investing, which is investing in mutual funds. And what mutual funds are, there's different kinds of mutual funds, but a mutual fund is, just by conceptually, it's a pool. It's a pool of stocks or bonds that people participate in. And so a stock mutual fund will be a pooling of funds that they'll go out and they'll buy and sell shares to invest. They'll buy or sell shares in the fund to invest in stocks. The bond mutual funds, of course, they'll do the same thing for bonds themselves. All of these mutual funds are out there, are managed by professionals who are going through and doing all sorts of their own stock analysis and bond analysis to try to determine what is the best thing to get the highest return and increase in valuation in the portfolio itself. What are some motives for investing in mutual funds? Well, especially for us as individuals that may have smaller investments, $10,000 or something like that, we can go out and receive the benefit of having diversification of that fund rather than an all or nothing kind of deal that is puts us at higher risk. Also, you're able to piggyback on the expertise of somebody who theoretically is a professional in this, and it helps you to meet specific investment goals. A term that's out there is called net asset value, and this is just the market value of the securities that are in that fund minus anything that is owned in that fund. And usually you'll find that reported on a per share basis itself. There's a couple terms that the book talks about open-end funds, closed-end funds. You can read those in the text. But I do want to mention this one term that for some people, it may sound strange to them, and that's the load versus no load funds. And a no load funds merely means it's a fund that manages and transacts business without charging a fee. And a load means that there is a fee or a load or a burden for that transaction that is charged for that. And these fees, and the reason I mention this is depending upon the size of these fees, that can have a significant impact on investment performance. So if you are getting involved with mutual funds, you always want to just kind of find out if they're a load or no load. Because if there is a fee or a load that is put into the fund, you have to take that into account. Because a lot of times they may just tell you what their returns are without those fees in there, but yet they have significant fees. There are all sorts of different kinds of mutual funds out there. There are stock funds, there's real estate funds, but just understand that there is always a trade-off on the risk of these funds, and because there's a trade-off, there's a return associated with this. And I will move my picture just so you can see the graph here, where at the bottom axis, the x-axis shows the increase in risk for these kinds of funds, but also on the y-axis, the potential return. And you can see here that If you were to invest in an index fund, for example, there's a relatively low risk that you won't be able to receive your monies back out of that. And again, this is sometimes it's a New York Stock Exchange 500 index or other kinds of exchanges there, and the potential return is relatively low. But as you start to go onto the graph, you start to go the Capital Appreciation Fund, the Global Stock Fund, Technology Sector Fund, Foreign Growth Stock Funds that are focused on one small country. And there's all sorts of other funds that just all fall within this spectrum here. All of these have risks and returns. And if you hit the jackpot, you decide that you want to be in the Foreign Growth Stock Fund for North Korea, very high risk, but maybe there's a potential of a high return there too. I don't know. I don't think I would put myself into that one. So, it really comes down to you determining your investment objectives as to what you have decided as an individual that you want to do, what your tolerance for risk is. And once you begin to understand what am I really looking at for my return, what is my liquidity requirements, what's my tolerance for risk, you can then start to zero in on the characteristics of the particular fund that you want to look at. You can review the prospectus. Again, if you're going through a fund manager, they're going to always have a prospectus for you to look at. All of these things, in the prospectus itself, it'll help to lay out what some of the goals of the fund are and what you might, not what's guaranteed, but what you might achieve in that, as well as whatever the past perspective are. In the prospectus itself, it also will lay out the fees and expenses. So you can have an understanding what the maximum fees are in that. And if there are any fees when you go to end your transaction, because it's not just the ongoing management fees. Quite often there are transactional fees that are associated with that. And you also want to understand just what the entire expense structure is that is folded into that. The prospectus will also go through and is supposed to outline what the potential risk factors are. This helps you on your risk tolerance to be able to look at it, and it's a distribution. It'll show you what the distribution and how those things should be treated on the back end itself. It'll highlight minimum investment, minimum balance requirements. It'll give you instructions how to buy or redeem the shares. And allows you basically to really narrow down your decisions. Now, I have not put these tables that are referred to on the slide in here. You can go on and look at the full slides that are provided by the publisher through Moodle for this week for you to go and look at some of those things a little bit further. So the question comes down as to how they fit within your financial plan. One of the important things is just to understand diversification. And obviously when you diversify, you have an opportunity to spread your risk out a little bit more. You can diversify among funds that emphasize different countries. You can diversify amongst different industries. You can diversify based upon all sorts of different criteria out there. And whatever it is that fulfills your investment goals themselves. And that's why, even being involved with things like hedge funds, unless you are very wealthy, those are things that you probably want to avoid because, yes, they do have higher returns, but they are also a higher risk, and there are significant investment minimums usually associated with those kinds of things. Until next time.